What's up, Mortgage Coach community? I am sitting down with someone that it's been way too long to sit down with, who every time I'm with him, I get great quotes, I get great wisdom. Just to me, one of the smartest people in the mortgage space. John Downs, welcome to the Mortgage Coach community, brother.
Oh, I appreciate it. I always have so much fun hanging out with you and Todd on these.
Yeah, well, a lot has changed since our last interview, aside from just being on the other side of COVID and the massive digital transformation that's taken place since then. But I'm now the Chief Innovation Officer of both Mortgage Coach and Sales Boomerang. And you work for a company that leverages technology that has both Sales Boomerang and Mortgage Coach. So I'm excited to hear just how you're leveraging this technology, but I'm also excited to hear about how you're approaching this market. So John, real quick, it's been so many, it's literally been multiple years since I interviewed you, but I did a little search in our group and just to see when was it last that I interviewed you, and I did how to increase your realtor referrals. That was 4 years ago. That video had 7,600 views. I remember when you adopted Mortgage Coach, you were kind of a long time holdout, and the way you adopted it in the process, I think 4 years ago, we created fast track adoption with new technology with John Downs. You remember that?
I do. Yeah, I still teach those philosophies to so many loan officers who find that hurdle of starting, right, to become a mortgage coach disciple.
Yeah, well, it's not just Mortgage Coach, it's really any new technology. I think we focused that 4 years ago. And by the way, it has almost 1,000 views. My guess is after this interview, because I'll put a link down below, it'll go over 1,000 views. And then 4 years ago, we did the cost of waiting mortgage strategies with John Downs. At that time, you were averaging, I think you did 70 million in that year. Well, I could go down the list. John and I created a lot of content pre-COVID. He got busy last couple of years. He did about 149 million last year. And John, you think you'll hit around 85 million this year, even though we're pretty down?
Yeah. So like a lot of us, right? It feels, if you compare yourself to last year, you might feel like a loser, but I still feel mildly successful this year, despite everything that's going on.
Well, you should feel more than mildly successful with 85 million in production in a year like this. So tell everybody a little bit about your mortgage practice, and then let's get into where your head's at, best practices in this market, and what are you focused on?
Yeah, so I'm in the greater DC metro area. So think mostly in the city of DC. And, things definitely transition. I think every area had its COVID response. Some wound up seeing a massive uptick of work from home, right? People that relocated into their market. And then, of course, others on the side where people were moving out. DC is unique where I think there was a mild exodus of the city, but they literally just went about 5 miles out into the suburbs all around. So, it was still a thriving market, definitely still some, weakness in condo space and things like that. So there was some pivoting that I think a lot of us needed to do. One, just from the COVID response. And now, of course, we have this year being rising interest rates, a pivot to ARMs, an understanding of buydowns, the kind of requirement to just get out and do everything, whether it's even broker some deals or find some little credit unions, and, as a product and rate sensitive time. So it's, my personal practice is it's me plus two now. So like a lot of people, downsizing a little bit. So I would put myself on the advisor side. I have another loan partner, Josh Brower. He's also, what I call a mortgage advisor. And then kind of, we have a processorless system. So I sort of have my, app to close coordinator, Vicky. We've been friends for 20 some years. So pretty small practice, high touch, high service, but also in a market where our clientele is pretty sophisticated. So loans are, I don't want to give myself credit for doing a lot of business saying I'm the smartest guy in the world. I also have really, really squeaky clean borrowers. So there's a little bit of that goes into it.
Well, with those squeaky clean borrowers comes, very rate sensitive, very, you got to deliver an incredible experience up front, and you got to deliver an incredible transactional experience. And then I noticed that you call your team mortgage advisors. I have this thesis, because now, that I did that private equity deal last year, and it's Mortgage Coach and Boomerang, I've learned a lot about the power of data. And my thesis is, technology companies are not going to eliminate loan officers, but data-driven mortgage advisors are going to crush average LOs. And so I really look at you as you are now, because you've got Sales Boomerang and you're monitoring your database, identifying signals and insights where a transaction may be, and then you're also delivering advice. Could you just walk us through how how you're executing on that, being a data-driven mortgage advisor?
Yeah, so there's really two parts to it, right? There's the tech side, which is so you could say, what is the tech stack that you use to perform at a high level, and for the two specific that you control. So it's funny, just yesterday, Boomerang, I wound up getting a trigger alert, a credit inquiry alert, and it was a past client, did a loan for them 2 years ago. They were buying in a state that at the time we weren't licensed in. And it fostered a phone call. Hey, just checking in. It's like, yeah, we're just thinking about buying a second home in Delaware. Oh, we got licensed in Delaware a few months ago. Oh, fantastic. I'd love to get a quote from you, right? So there is some parts of technology that just keep you connected to your clients. There are other forms of the tech, such as MortgageCoach, that sort of up-level the advising thing that we promise, which is we're going to show you everything. We're going to teach you all the things you need to know: time value of money, tax savings, different alternatives. Should you buy rates down or not, ARMs or fixed, temporary buydowns, fixed buydowns, and I think you kind of need a lot of that, but then you also need the foundational knowledge of what are those things you should be showing. And what I love about MortgageCoach specifically is it can turn a rookie loan officer into a pro pretty quick if you just play around with stuff and you just analyze it. Oh, what if I bought the rate down? What's the 5-year savings, the 10-year savings, the 15-year savings, right? And so I think there's definitely the advising side of my practice is more a combination of 20-some years experience, really being affected in the downturn in the GFC or the housing crisis. But then also diving down into really understanding markets. I'm kind of a Twitter fanatic now, and I think I follow some pretty smart people and look at all their charts. And, I always want to say, I want to give advice that is not gut and it's not salesy, that it is backed by something. And sometimes the advice is, I don't know, it could be this or this based on this or this, where do you and your life and your goals fit into that? Right. But I think it's well-rounded. That's all.
Yeah. Well, I think data-driven in all facets. You're data-driven by having your database monitored and predicting who's most likely to buy, sell, or refinance. You're data-driven in terms of data from people you respect. Real quick, who are a couple of the people that you're following that you are getting some of the most value that you're willing to share with?
You know what? Let me pull it up, because I sometimes don't even know their names. I like picking on Jim Cramer, so you'll always see me comment on his stuff. So there's, what is it? Mike, is it Simonson? He's from Altos Research. I love his stuff.
Simon, what's his name again, Jim? Let's do this. We're going to get John's 3 top data sources. I'll put in a few data sources and we'll put those in the show notes down below. So if you're watching this in YouTube, you're going to get some show notes from us with some people that John thinks you should follow and some people that I think you should follow.
And the key to a lot of that is, the key to a lot of that is following it and just putting your filter over top of it. So I think the problem is so many people are looking for something to sell instead of experiencing it, right? So like if I see a chart that used car prices are dropping and I'm looking at loans of people that bought cars recently, and I just asked them the question, hey, what was your experience? Or why are you not buying something? So you can kind of use real life with what others are saying. And that sometimes the true story is somewhere in between.
Right. Fair enough. So I want to go to this part of the pivot, that we've had a pivot. You use the words requirements in this market. There are some requirements to winning in this market. So what is the pivot you've made in your practice this year? And I'd love for you to share what you're doing today And then if you did have some vision on how Q1 is going to go, what are you doing today to get loans now and when? And what are you doing today to prepare to kick ass in 2023?
Yeah. So when I keep using the word pivot, it's because I'm hoping the Fed does it soon. But at the same time, it speaks to our business. So, in my market, so I'm going to be a little specific to my market, but I think a lot of people can relate. But we went from a convince or educate through the idea of escalations, and then all the things that it took to win, which was speed. It was waiving all your contingencies. It was, in a way, very easy. Hey, if you want to win, you got to pay the most. And let's look at your down payment and different equity positions. And here's how your loan will change if the appraisal comes in low, and maybe you re-underwrite the thing. So that was actually pretty easy. The pivot I'm talking about is more that there's a combination of factors that fascinates me. So one is I was at a real estate conference just a couple of days ago in Austin, and there's a room of about, I think there were 100-ish agents all around the country. And the speaker said, hey, how many of you were in real estate prior to 2009? And like 5 hands went up. So I think there's a big chunk of people selling houses that they didn't live through the last downturn. So I think number one is there's an education practice of people that got in the business over the last 13, 12 years. Here's what we experienced. Here's kind of what happened last time. Here's what could happen this time. Here's how to survive during that. Here's the products that they use, just different ways of thinking through it. So that's number one. And then number two, I think you have an affordability issue. So of course, the industry is sort of solving that by pitching temporary buydowns, permanent rate buydowns, adjustable rate mortgages, right? So it's understanding the tools that you need to solve the affordability issue. And then, but the third thing is probably the one I'm doubling down on right now, which is building a story of the future with some facts behind it, because I think the next crisis we're going to have is going to be a confidence crisis. So in the last week, as an example, there's a whole lot of stuff that's happened that is pro interest rates. Bank of Canada increased 1/2 instead of 3/4. The EU came out today. They raised, but they were cautious of the future. They say that Fed Whisperer kind of published that article in the Wall Street Journal the last day of their blackout period ahead of the next policy, saying that maybe they'll be more cautious. Economic data is coming in a little soft. Like there's a lot of stuff showing that rates might be peaking and that mortgage rates might start improving. But then you still have a confidence crisis. So how then do you say, okay, affordability's fixed, you should go buy a house now, or you should prepare to buy a house, or what are your bottom indicators that will make you feel comfortable to move in? And I know I'm rambling here, but some of it is going over the 2018 timeframe. Yeah, so like late 18, I found in my CRM countless conversations of people that were trying to buy in early 18, but it was competitive. Then in late 18, they had opportunity, but the fear made them paralyzed. And then, of course, things reversed. Rates dropped in 19. The market got competitive again. And many of those people didn't buy a house till June or August the following year, and they paid 10% more. So it's kind of like understanding points in time where you can use your experience and tell some stories to help people think through what should their offer be, when should they get active. So maybe to put a button on that, my 2023 Q1 story is putting all the facts to tell a compelling story of my local market, of who should be buying and what more than likely is going to transpire next year.
Got it. So that is, by the way, that's super powerful. And as I've been interviewing loan officers this year, I have noticed the top producers, not only are they giving every family a total cost analysis so that it's based on that family's assumptions and goals around what help them make a decision, but they've also got some kind of go-to insights. They've got some slides, and I'm going to show an example of one that caught my eye that you shared a few days ago. You shared this on Facebook, and I put it in the MortgageCoach group. And this is just a good example of a piece of insight that helps, tell a story. And I don't know exactly who you got this insight from, but what's the guy's name? He's someone that
he's a Freddie Mac economist. If you scroll up, I think, oh, there it is at the bottom, at Len Kiefer. He is a he's one of the guys I follow on Twitter, right there at the bottom of the screen. He is, he basically just runs a bunch of data. And to your point, these stories, so that prior slide as an example, I've been using that frequently to say, let's understand what just happened, but let's also see what can happen next. And you can tell many stories. I sort of mapped it out better in the copy of that post. But when you follow these years, you're like, wow, so we went up 4%, dropped 3%, went up 2%, dropped 6%, and where are we? Which one of these years are we most likely resembling and forming? And I think you could look at 1981, and what if we are in that same thing? The Fed was really aggressive, and then they start having an impact, and then bam, you kind of snap your fingers and rates drop 2%. There's still rate of change, and rates were a lot higher back then. There's more to the story about percentage drop, but I think that just gives you real life examples of how prior inflation periods have behaved. And then you can kind of, again, put your glasses on with what you see in your local economy, what you're feeling with your investments, and then kind of look at your goals over the next 10 years and make a call on what's best for you to do.
Yeah, no doubt. Well, and one thing, guys, I could tell everybody in the mortgage space right now, well, from a budgeting standpoint, from a team standpoint, from a forecasting standpoint, plan for the worst. But if you're not preparing for the best, like if you do not have sales boomerang and the ability to have a rate watch alert and the ability to have a rate and term alert that auto creates a total cost analysis so that you can go from rates tick down and this person's in the money to you've got a powerful presentation that you can deliver to that consumer, you're just outmatched. John Downs and thousands of loan officers, hundreds of companies have sales boomerang, and they're locked and loaded. Their database is well prepared that as the market does shift, they're managing mortgages. They're reaching out to families and saying, hey, I promised that I'm going to manage your mortgage and make sure you achieve wealth with real estate. And when it makes sense to upgrade your loan, we're here. Like you're just outmatched, right? So John, I can only assume that's one of the things that you are prepared for. Like that's not your day-to-day, but you're prepared for that.
Yeah, so at Fellow Mortgage, we didn't have sales boomerang for a little while, right? We were in the middle of the refinance wave. Things were going bananas, companies growing, we were doing a bunch of stuff. And in our minds, it was like, all right, well, if we're going to spend the money, do we really need it right now? And so then earlier this year, we signed up for it. And some people were like, why are you signing up for it now? You're crazy. Rates are going that way. And it's like, yeah, but as rates do keep going that way, the other side of that is going to pay dividends, right? Because then all of a sudden the aggressive step downs, we're going to have all of those. The other thing that's been really useful this year that I don't know if a lot of people realize with sales boomerang, but if you can set up your system so that your prospects go into the data, you can actually get inquiry alerts on your prospects. So it doesn't have to be closed loan stuff. It can be loan retention at time of pre-approval or slightly before. So I think that has definitely won us back some deals this year, right? You talk to someone in, a prime example, there were a couple in, was it June, July, August when rates dropped a bunch. And if you quoted someone, let's say in mid-June, I could be off on the math here, but let's say it was 6%. And then they read a headline or they talked to some other lender a month later and rates were at 5.25%. They could in their mind be like, oh, John sucks. His rates are high. This guy is where it's at. Well, that inquiry came back to us that we could then send the email, congratulations, by the way, rates have been improving. Here's kind of what our current forecast is. Would love to reconnect. And then boom, you're reconnected, your rate's better, or at least similar, and you win. So there was some customer retention, even in a higher rate market, that Sales Boomerang provides a really good value for. It has to be set up properly, but
Well, I want to hit that home because a lot of people think that the whole concept of mortgages under management is just your past customers. And guys, to John's point, it's your leads, it's your active pipeline, it's your realtors and your partners, it's people that didn't qualify. And guys, and I don't know if you're doing this, John, you've got such a powerful database with Sales Boomerang and with MortgageCoach. You can really make the case with a realtor that, hey, like realtor, this is what your database looks like. This is what my database looks like. And I can be giving you a heads up that someone listed a home. I can be giving you a heads up that someone pulled one of your past clients is shopping. I can, let you know when one of your prospects credit improved. I can not only do that, but I can create this, and they know it. You can create these amazing presentations so that your database really becomes a tool for the agent. And for all you boomerangers out there, the cash out insight, I mean, not only is that an opportunity to do a cash out refi or a home improvement, it's an opportunity to get a possible move up. Maybe in this market, it's kind of hard because rates have gone up so much, but as rates start going down, and someone's got a legit credit score, they've got real tappable equity, those are people that can move up. And here's the other thing, John, I don't know about you, but I think as markets start to go down, there's going to be a lot of people that maybe they don't want to sell that home that's got the 2% interest rate, but they've got enough equity that you can start having really proactive conversations about, hey, let's rent this house out, how to house hack, and let's move up. Like the real ninja loan officers are gonna be creating opportunities as the market shifts. You agree with that?
I do. Yeah. And you just gave me a great idea. I had never thought about adopting a realtor's pipeline of clients. I think that's really, that's a big takeaway you just gave me. So thank you for that.
You obviously haven't watched my interview with Josh Metal or Wally Elderberry, but they're going to town. They're adopting databases of insurance agents. They're adopting databases of realtors, and it's a big deal. Like it's a big opportunity.
Wow. Can you put that also in the same link description? I'd love to check that. I need to check that one out. That's awesome.
No, I'll share that with you. So let's make sure before we're out of time that we do like loans now. So I feel like community takeaway number one, you need to be able to build a story of the future with some facts. You need to be prepared that as the market shifts, you've got the automation in place, you have the skills in place. You may not have all the team members, because remember, we got to plan for the worst, but as it shifts, you've got the systems in place and the skills in place. Now let's go to loans now. What are you doing to get some people off the fence and into escrow? What are you doing to drive some transactions for your agents right now?
So, I think the 2-1 buy down, the industry did two really good things. They did the 2-1 buy down and the date your rate. And that flooded every real estate agent in the universe. And a lot of borrowers have kind of heard about that. I'm taking a little bit of a different approach in the sense that I think you have an amount of seller money and it's trying to explain all the best uses of the seller money. And, in my market, closing costs are 3%. So if you put less than 10% down, you can only get a 3% seller credit. So why am I going to do a seller funded buy down? Why not just have your closing costs paid and essentially same thing, but you control your money. So you put 10% down or more, and then that's where the buy downs kind of come in. So it's kind of like explaining to all the agents out there, what exactly is the time and place and loan structure to use all these various things. Another thing I use to kind of be the other side of the 2-1 buy down is, but why not just buy down a 10-year arm? We had some arms that were at one point, if you throw 2 points at it, you could be 1 3/4% better than a fixed, and it's at least guaranteed for 10 years. So why do a buy down when you can do the arm? So I don't know if I'm answering the question, but that's the big part of it is the seller might give you money. What is the best use of the money? so that it doesn't go to waste. And then you throw some what ifs in there. Like in 2009, I had a guy pay 3 points on a $650,000 loan because he got a 5% rate or something. He thought he was the smartest guy in the universe. And 6 months later, we were doing no cost refis at 4.5. And I use that story somewhat frequently. When I called him, he was like, yeah, I probably shouldn't have done that, right? I should have just bought my loan down. Yes, you probably should have. But we don't know the future, but we can sort of be predictive-ish as we make our decisions. So it really is just doubling down on education. Obviously when I said we have a confidence crisis, we went from fear of missing out, where everyone thought buying real estate was the smartest thing in the world and values are going to go to the moon, just like crypto and just like stocks and just like every other, meme stock or whatever. And then we pivoted to fear of buying the top. So now I don't want to buy because I think things are going to go lower. What is the justification of that? What is the data behind that? What are the inventory levels? What are your average income in your area? So I think it's more the education of your local market that leads to okay, you can structure things like this, find what your best is. What is that thing that makes you feel good, and go out and write those contracts. People might laugh at you. Sellers might rip it up, not respond. Who cares? We're in that kind of market, but don't not look. Just put your framework together, just like a long-term investor would. What is your framework? Where does it work for you? And go see if you can make that happen. And it might not, but at least have data behind it that proves what you're doing makes sense, and that you're just not sitting and saying, forget it, it's a bad time.
So one of the things I've noticed in the interviews that I've been doing, especially for the past 30 days, is every loan officer kind of has their go-to strategies, and they are different in every market, and every loan officer has kind of some nuances. So I'm going to go through a couple of the go-to stories that I've seen most often, and then I want you to be ready to share one of your TCAs and share one of your go-to stories. Now the one I'm seeing the most, and I'm hearing it called different words, but this video that Jeremy did is the most trending video for the past 30 days, where it's called Date the Rate, Marry the House, Divorce the Rent. And he's kind of, and I'm sure you're doing this, where he's kind of showing some affordability strategies. It sounds like you might have done like a 10-1 buy down here to say, hey, you can pick the house you want in this market, and there are some ways. You may have just done a 10-year and not buy it down, but whatever, you're kind of showing something here, and then you're showing the future rate. So it's like marry the house, date the rate. So one, are you doing that, John? Is that a move that you have?
Yes. So it is, I think I'm trying to find some that I can also share, but so yes, the date the rate, marry the house, or, my wife always makes fun of that one because she quite like the commentary, but yes, that is definitely a strategy. Now, again, I don't know if that still answers okay, thank you. You helped drop my payment to $5,000, but what if that $900,000 house sells for $800 next year, right? I still think there's another side of the story.
It doesn't. So let's come back to that with you. And then there's, hey, divorce the rent. And you start to really show, one of my favorite examples is this is a new loan officer on his 10th month of the business that did $1 million on his 9th month of the business in mortgage. And this was a buyer who, was going to wait a year. Rates had gone up so much. The buyer said, hey, this is scary. I'm going to wait. And then he showed a house hack strategy. Hey, you could buy a 3-bedroom house, rent out 2 of the rooms for $650 each, and give that $1,300 to a financial planner, and look what could happen in 5 years. And based off your assumptions. And that person was off the fence and into escrow. So those are the things I'm hearing the most. So 2 things. One, I'd love to hear kind of the John Downs talk track to that. And then 2, do you have a go-to strategy that you're using in your market that helps you serve, buyers, sellers, and agents with clarity?
Yeah. So I don't know if I have a go-to, because everyone's a unicorn and their little situation's different. But one strategy
you want to share that you think would be useful.
Yeah. So, I mean, I got a lot of them, right? So in DC, there's a lot of renters, and, one story is kind of what you said about the house hack is, hey, parents, why don't you, or real estate agents, why don't you go to anyone that you hear is renting and say, have you ever thought of just, what if you could live for free? You and your parents bought a house because you already have roommates. Why don't your roommates just kind of subsidize your mortgage? There have been some where we have 2 units in our market. Some people are choosing to buy the house they really want and they rent the upstairs at a big number. They live downstairs for a year or two till they can refinance and restructure. So that's, again, a little bit of a house hack. So live in the smaller 2 unit, rent the bigger one. Biggest thing is tax savings. I would say if there's my go-to is I think that is wildly lost right now. The tax savings is pretty massive. And for everyone out there, my quick calculation is total interest minus standard deduction plus 10,000 times top tier tax rate for state and federal. So better said, if my mortgage interest is 40 grand and I have a single borrower, standard deductions like 13 grand, add back 10 for SALT. And then you take 37,000 times that percentage. And that's kind of what their refund is. And I'm using that as a subsidy of the big increase. So if payments went from 4,000 to 5,500, but your tax savings went from 300 to 1,100. Well, and by the way, this year, what was your raise? Your raise was 10% after taxes. That's this much. So really, you're no better off than you were last year at lower rates because you made less money last year. You didn't have the tax savings. And right now you're getting a better price on the house. You make more money and then the tax savings nets it out. So cash hitting your bank account at the end of every month is kind of the same. So that's probably, if you say my go-to, that's it. Takes a little bit of time to explain through it. Not as lucrative for married people, depending on your price segment. But that one has been very helpful.
So are you using the life alerts? One of the things that we're really pushing folks is when a family has a kid graduate from high school to reach out with hey, how not to pay housing costs while your kid goes to college, or when a kid graduates from college, hey, how to help your kid, buy a duplex, triplex, or a house hack, a 3-bedroom unit house for their first house. Are you kind of reaching out proactively on that?
So I know the life alerts are newish and I need to check to see that we're doing it. That would be awesome. If you think about the amount of work that it takes as your pipeline gets bigger, when you're a small new loan officer, it's really easy. You can remember every client. You have maybe 100 and you're like, oh, I know those 4 people have a kid going to college. Your pipeline gets bigger, 3,000, 4,000, 5,000 people, you need something to deliver it to you.
What's the size of your personal database?
I'm going to go with about probably 2,000 families.
Okay. 2,000. All right. Well, let's go to a total cost analysis. We can't wrap this call up with John Downs and not see a John Downs TCA, because guys, I can guarantee it'll be smart, it'll be thoughtful, and you'll learn something.
Yeah. So I tried pulling one up like really fast here. And, one that I'm using is the education, right? Because I think we have a lot of things that we need to kind of run through where people just conceptualize what has happened. So I did this a little while back for a realtor presentation where I basically said, hey, here's that $600,000 house. And then rates went up, rates went up, rates went up. And if I kept the cash to close the same, how much house could I afford at new rates? And you could see that drop, right? It went from 600 down to 441. So that was just me giving an example. And then I have other presentations. I couldn't find it really quick, but we can link it in the comments after, where I took this same thing and I said, okay, well, what if you use that same 48,000 and you did a buy down? And what if we added the tax savings at the higher amount to the monthly payment and pop that up? And what I noticed is that you get really close to last year. And I think that's what people need to kind of hear is that, this year's awful. How do I get to, last year could have been so much better. That thought pattern is where the crisis of confidence comes from, so that you need to show data to say, yeah, but, right, here's how the world evolves.
Hey, by
another
the way,
one
show on my screen in this view, want to remind everybody that you can adjust the view, but I think this might be easier for people to see it.
Oh, sweet. Yeah.
So, so walk through this one more time. I just want to make sure everybody gets the lesson and kind of give the teaching to like you're teaching your team of loan officers how to use this as an educational tool.
So the audience, so I've used this several times, some with real estate partners, mostly with real estate partners, but also with buyers to say, here's just what's happening with real estate. So in December of 2021, you could get a 3.25% rate with no points. If someone put 5% down, they would need $48,000 and their payment would be about $3,080 a month, right? So that's just explaining the high level of that first column and say, but let's just go through the year. In March, rates jumped to 4.25. In June, 5.375. In October, 6.625. Now, if I kept the cash to close the same, so of course, as the sale price goes down, right, you need less cash, but I could kind of use some of that cash to either pay down the principal or buy points as an example. If I keep the cash to close the same, because let's say you still had that 48 grand, but you didn't want to pay more than 3,080, then here's kind of where the sale price would change. And that's a massive difference, right? It's a 30% drop in housing prices in order to keep the same payment with the same cash. Right. So there's a secondary presentation to this that says, but there's more to the story. And then you can kind of peel into the tax savings. Then you can peel into personal income. And then you can peel into interest rate buydowns with seller, right? It's that $600,000 house last year. If you bought it for $600 today, you probably get a $20,000 credit. So if you use that money, how close can you get to last year's payment? So there's a lot to the story, but that was maybe a starting point where it's just realization. This is what has happened. Now there's another thing, and I don't know if you want me to try and share.
Anything you want to share, like think of this as a virtual site visit and we're digitally parachuting into your office.
Nice. So this is the guy, Mike Simonson, I think, of Altos Research. So I think now you can do this for free on Redfin. I think Redfin has something similar too, where you can kind of do local data. This is just a county in my market, Montgomery County. And what I like showing people is just what really is going on and why, you hear this inventory discussion. Real estate agents say prices can't drop because there's no inventory. There's a little bit of that that's true. So in my market, as of this week, we have 690 roughly active units, single family homes in Montgomery County, Maryland. And if you go back to the last quote unquote healthy market that we had 1,600. So that proves the inventory story, and then you can go down into different segments. I've been showing this a lot lately. Doesn't look as glamorous this week, but I can see how many new listings come out every week, and I can see how many new contracts occurred every week. And what's interesting is as price decreases have been going up, all of a sudden last week, homes under contract went way up. So there was a legitimate pickup. And sometimes I use that to show as these prices go up, it finally price decreases. So as prices decrease enough, mixed with creative strategies of buying down rates, mixed with, other incentives that come out, mixed with confidence of the future and understanding, I have a lot of people right now already knowing what their raise is going to be in January. And if you write a contract in October, you're not settling till November, you don't have a payment till January anyway, and you'll probably be making more money. So again, it's using data to tell the stories, to build the confidence. And I don't think I'm misleading with any of it because I believe it.
I love this. I actually wrote a white paper over a decade ago called The Power Shift. And you're doing the power shift. And you guys could Google it, probably Google Power Shift or something like that. I'll put a link down below to this white paper. But essentially, the way it rolls is if someone believes that you have extraordinary knowledge, and if you listen to John Downs and you see the charts he's using, you see the way he's telling stories with data, with MortgageCoach, like you're going to believe this guy has extraordinary knowledge. And if you believe that he has your best interest in mind, and because he's showing transparency, he's showing data, you're going to believe like he's got my best interest in mind. called ethos. He has ethos. He has credibility. He's using logos, pathos, all the skills of influence so that people are less likely to shop him and people want to do business with him. You know, now the antithesis, like, let's just say you had a family member, your brother got in the mortgage business. You could trust him with your life, but he doesn't have extraordinary knowledge. So you shop him. You know, it could be John Downs and he's got all this data, but he's not demonstrating that he has your best interest in mind. You're going to shop him. Like John is doing the power shift. You know, he's showing transparency, he's showing data, he's getting credibility, he has ethos. And guys, that's what it takes in this market. You know, last year's market was a volume market, and it was all about how quickly could you manufacture loans in a quick, efficient way, and what kind of team leader were you so that you can put people and process around volume of transaction. Guys, this is an education market. This is an ethos market. This is a market where you need to have data. You need to be a data-driven mortgage advisor. And John, you did not disappoint. You basically kind of showed how you're using data, how you're a mortgage advisor. I definitely want to take you up on that part 2 of the TCA. You cool with sharing that?
Oh, 100%. Yeah. Yeah. Because I do think sometimes you need multiple TCAs to tell the full story, right? And to your point, you know, when you have my best interest in mind, you know that I think every story there's both sides of every story. There's like yes, but to almost everything out there. And I think it's important to recognize the yes, but. You know, my brother, Rob Downs, Atlanta, Georgia, shout out. He and I get on a conversation about 2 on buy-downs, and he's really negative on them. And he's really negative on them because in his market, he believes that you should just have your closing costs paid because of how much money people put down. It's not that usable. It's a gimmicky, whatever. So the yes, but is just show the options, right? Like it's, you can do this, you can do this, you can do this, pros, cons. I don't know if it were me and I'm in your shoes, I'd probably lean this way, but you can do either. If you win that one, it's not the end of the world. You know, I think it's just not being sold on a path and being super honest and transparent with what's possible. And that's when the buy-in comes. You know, when I have people just say prices won't drop because inventory's low. Yeah, but right. There's still people that have to afford that house. There's still income challenges. There's still payment challenges. There's still stuff. Like, yes, I still think prices drop. I'm a prices drop believer. I think in my market, they already have though. So, you know, there's the other side to that story. Anyway, that was the point I wanted to make is sometimes you don't have to have conviction on one thing. You can have beliefs and then you can tell the other side. And I think that's where the trust comes.
Well said. Another one of my favorite interviews this year was with Shivani Peterson. And, you know, she was talking about rep versus own, which she does all the time, but she called out a lot of loan officers for what she called rent shaming. And she's like, you know what, we're just here to provide the data, help them make a decision. And I do think, you know, in this market, guys, we need to show up with a lot of empathy. We need to give people options. We need to give them data. And anyways, you epitomize what it is to be a mortgage coach. If you did have any scripting on how you're calling a sales boomerang trigger or alert, what is your approach to that? Whether you have team members doing it, whether you're calling on some of those alerts, I would just love to hear a John Downs best practice, because I've been interviewing a lot of boomerang loan officers to hear what they do and how they do it. What are some of your philosophies?
You know, we basically, so we haven't nailed it down, and it depends on the person and the relationship that we've had. But, you know, sometimes we just say, you know, we monitor our pipeline for a whole variety of reasons, you know, in some cases fraud related even, and notice that you had an inquiry of some sort, one, making sure you're aware, and then two, just to see if we could be of any service to you. You're a valued client of ours, right? That might be one.
Service. So the service approach.
Yeah. You know, and I find that to be a little bit better, meaning they call back, than when I used to try to hide it. And I would, hey, it's time for your annual mortgage review. I worked up this mortgage coach for a blah, 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 blah. Would love to get, and it would just, you know, some people would be like, wow, it's weird. I was just had my credit pulled this morning, and it just felt disingenuous. So, but the first one I think is the one that we kind of feel best about, and it doesn't, and why would you watch your pipeline? Well, for one, there's a lot of fraud out there, right? And just make people aware they don't have those alerts. And two, I believe personally that many call centers, many solicitations, and many servicers, I think they're in the business to drum up revenue and not give good advice. So I proactively want to monitor that so that people aren't getting sold a bill of goods, that whatever decision they make is an honest one. And that all your personal goals are in mind as you make that decision. Case in point, my wife's mother's best friend did a $20,000 cash out with my old company because she got a letter that said your payment's only going to go up $50 a month and we can give you 20 grand. I didn't work at that company. It's like, oh, my servicer, they must be thinking of me and doing the right thing. She had $8,000 of closing costs and they added 7 years to her mortgage to get 20 grand. She had like $100,000 of equity. She kind of got an equity line for free. Like that kind of stuff drives me insane with our business. And so that's why we have this credit monitoring service to make sure people don't get stuck like that. So that's my play on it.
Well, I just want to remind everybody that, going into the market that we're in, it's, like our goal at Mortgage Coach and Boomerang is to deliver on this promise. This is what we are all about. This is what I'm all about in this next iteration of my career. Is, I was always jealous of financial advisors because they got paid a predictable amount of money consistently. It's called assets under management. I was always jealous of insurance agents. They got paid. It's called book of business. And I know for a fact, as mortgage professionals, the more I've learned about data and what I've learned through Mortgage Coach is you as a loan officer can have a predictable, consistent amount of income. It's called mortgages under management. And the next iteration of that is realtors could get paid every year. It's called working with a data-driven mortgage advisor that's powered by Mortgage Coach and Boomerang. So I would recommend, John, it sounds like you're not necessarily, you don't know if you're getting all the alerts. I don't even know if you know that there are integrations where, you can get these alerts and it creates a TCA, but, not only is there opportunity in this market for everyone watching this, like there are loan now in your database. People are still getting divorced. People are having kids. The real estate business is a life events business. When people's credit report goes up, it's motivated by all the things that happening in their world. And if you're not monitoring the database, you're really missing out big time. And if you're not delivering strategies, like not a fee worksheet, but a strategy to a consumer, you're really missing out. So John, any closing thoughts before we wrap this up? Any words of advice to your peers that are watching this?
The only thing maybe that I would say is I have the pleasure, although it didn't feel like a pleasure at the time, going through the financial crisis and feeling and experiencing the pain of giving bad advice and selling people into houses. And I would just say maybe spend some time, if you're young and new into the business, of going back into that era and just research it. What did rates do at that time? What happened with product availability? How long did it take local markets to improve? What were short sale rates and foreclosure rates and overlay divorces over top of that? And just the personal trauma that I experienced through all the people that went through that foreclosure, short sales, divorces, kids in bad situations, changing schools, like all that is what shaped me to be the advisor that I am. So it's easier for me to talk about it. But if you don't have those life experiences, you really can research it. And especially anyone in, let's say, the 28 to 35 range, your parents probably lived it or your aunts and uncles. So they just get real stories to build your database of your why. I guess is kind of how I would put it. But it is easy for me to be very transparent and try to be educational because I witnessed a lot of hard stuff on people back then.
So I think what John just gave you guys is, a message to grow your emotional IQ and not to be pushing your beliefs and to be more humble, to be more curious, And those are all things that are required for trust. If you want to embody trust, you need to have emotional IQ. So great advice. Also for all you new loan officers, if you do not have skills as an advisor, if you can't show someone, I don't care whether you call it date the rate, marry the home, whatever the term is, if you can't show those strategies, if you can't make a case for home ownership the way John can make a case for home ownership, you're missing the skills required to close loans now and to thrive in the future. So, grow your emotional IQ, grow your advice skills, and John Downs, man, you did not disappoint, brother.
Thank you. A lot of fun. Really appreciate it.
Yeah, make sure you guys, if you got value from this, like it, share it with mortgage friends that you think would benefit from this. If you're not subscribed to our YouTube channel and our Facebook group, Mortgage Coach Productivity Mastermind, get after it. And this is a wrap. Take care, everybody. And don't hang up, John.